Risk and return. We're going to look at the concepts of return, its components, um, the influences of risk on your investments and your level of return. We're going to talk about a brief talk of time value of money, which you've covered in Finance 330 and probably 2 or 3 other classes prior to this, maybe even in high school. We're going to talk about risk-free and required rates of return and holding period returns, calculations of yield and growth rates, key sources of risk, understanding risk as a single asset, the assessment of risk, and how risk and return work together to help decide where you want to place your money. Okay, so the basic concept is any risk that you take on, you're going to want some sort of return in the investment field. So if you're going to take a risk, it's got to be worth it to you in some way. And the way that it's worth it to you is that you make a return. And the components of return are really 2 elements: income, which can come in the form of dividends, or capital gains, which are the difference in the purchase of the price and then the sale price. So if you purchase at $5, sell it at $25, you made a $20 capital gain. So total return is going to be a combination of these 2 elements over a particular period of time. Most commonly, you like to look at return over a year basis. And the higher rates of return, obviously, the faster you can build wealth. That's why the common sense thinking is that when you're young, you want to put all your money in stocks because that has the highest return. It has higher risks, but if you're going to be in the stock market for 50 years before you retire, you're going to get your job at 22, and your retirement age I'll set for you will be 72. Don't worry, you'll live to 102 or more because life expectancy will expand. So you still have 30 years of retirement. But those 50 years you're working, you want to have most of your money in stocks for at least 30 or 40 of those 50 years. And that's going to get you a maximum return. But it'll be risky. There'll be points where your accounts go down by 50%. And it'll be scary. But if you maximize your contributions to your 401k, and you do that for your 50 years worth of work, then you will have a very lucrative retirement to retire on. And you may even be able to retire early, maybe 65. Okay, so looking at return is sort of like your grade in your investment. And we want to look at historical return to get an idea of where we've been, but this is by no means a predictor of future returns. And just about every mutual fund will say that. Now, your expected returns are what you're expecting to get. Sometimes expectations don't meet reality. And that's when you're sort of growing or understanding your investing world, you start to get a better realistic expectations of what your return can be. As for me, I don't look at my investments in stock as an annual return because I can't really have any expectations on the annual basis because any annual year, stocks could be up or down pretty intensely. So I look at it more of a 5-year period. What are my returns after 5 years or even 10 years? That's how my expectations are. I should at least get somewhere between 8 to 10% return in every 5-year period. And I think that's realistic. If you have unrealistic expectations, you'll see that generally they won't be met, and you'll have to really think about that and lower your expectations or change your risk level of what you're investing in. All right. So key factors of return as far as investments go, it's the risk of the investment itself. Is it going to be something that's going to pay off based on, a whole series of factors that can affect competition, the business itself, people's attitudes, demographics, economy, all these things. But there is a direct risk of the investment. And in the investment, there's, the management this is the internal, more company side risk. You have the management of the company, and then you have the financing of the company as well. So you have the 2 things have to work well. The company has to have a good financial decision making and strong basis, and they also have to have strong management. So if a company is run by good managers, they know what they're doing, and they can guide and expand the company, and they have a good understanding of when and how to utilize capital, is going to be a good investment. Now, external forces that the company can't control so well is, political environment. What's going to happen if you're an oil company and the governments of the world start to wise up and say, listen, we shouldn't spend $7 trillion on wars. We should spend $7 trillion in upgrading everyone's home to have solar panels. So if you're an oil company, you're in big trouble. Better hire some lobbyists, or better, get some, create some wars around the world to make sure that doesn't happen. Political environment, we just talked about it. Business environment, ups and down expansions of economies. That's something businesses can't control. You can't control, but it's a risk. The economic environment. Okay, let's step back for a second. I was talking mostly about the economic and business environments are pretty similar concept. I guess the business environment would be more industry related. So if the business of pharmaceuticals is going down because one company created a cure-all pill that will cure everything, so all the other pharmaceutical companies are going to go under. That would never happen. But just really the business dynamics. But the economic environment directly impacts the business. That's economic is going to impact all businesses. It's more overarching. Inflation and deflation. Deflation we haven't seen in a long time. But people do still worry about it, talk about it. It's basically when prices start going down. Prices of cars and houses and washing machines. And that's generally only one reason prices go down is when people stop buying. So suddenly people stop buying and companies get really desperate and want to sell. Say they made all these cars for the year and they need to sell them because they're going to be worth less next year. They're going to drastically cut prices to get them sold. And as people, when people start getting the feeling that prices are going to continue to go down, they're going to wait to purchase. And a good example is the real estate market. When the real estate market is going down and prices are going down, a lot of people decide to wait to purchase to see where prices settle. And that is a bad thing overall for the economy because everyone's assets will start to deteriorate and lose value. And luckily, inflation is easy enough to spark to control any type of deflation. And deflation is much worse than inflation. And that's why it really devastates a country. Inflation is bad too. But a little bit of an inflation is okay. When prices go up slowly, that's okay. We just don't want it to get out of control. All right. This is just, I know this is something from the textbook. You can't really see it from where you're sitting, but it lists all different returns in stocks by country and long-term government bonds, short-term bonds, inflation. And you'll see the United States over the last 111 years have had an inflation rate of about 2.9%. And a return of stocks about 9.3%. But each country is different. In some countries, the thing that changes the most from country to country is the inflation rate. And you can see a country like Italy had an 8% inflation rate, which is really, prices go up there pretty fast. Yes? Yes. Ask your economics professor. But it does make sense sometimes. It's out of scope for this class. That's a 20-minute discussion. Time value of money. I have to stay on track because we've got a test coming up. But feel free to see my office hours after class. Okay, time value of money. The sooner you receive the money, the better. That's why if you ever are going to play the lottery, which I don't recommend because it's sort of a tax on the mathematically deficient due to the probabilities. 172 million to 1 is not something you should worry about. And that's the odds of like the Powerball or something like that. It's on the back of the ticket. That's how I know. So anyway, if you did win, and you had two choices, the $300 million paid to you every year over 20 years, or $120 million paid to you today. And the first thing you should ask is, why is it so little? Why am I only getting $120 million today when I won $300 million? Because what they're doing is when they pay it out to you on a 20-year period, they are basically, they have 300 million, they're going to earn interest on it, and the money they pay out to you that first year, a bulk of that is interest they earned on your winnings. So you really didn't win 300 million. They're just inflating that with the returns of the money that they're going to make over the years of holding that and investing it for you. So if they're going to give you the lump sum today, they're only going to really give you the money they have, which is 120 million. That's what they were going to grow to 300 million over 20 years and pay it out to you that way. So it's always better to receive the money today because you can probably grow it at a faster rate than they can. And, there's no guarantees that they're going to be around, or the state will be around, or the country, or you'll be around in that whole 20-year period. You could die, and then you'll never get to enjoy all that money. So it's always better to have the money today. Like if you were going to get a job and they're going to ask you, do you want to be paid weekly, bi-weekly, monthly, or at once every 6 months? Which would you prefer? The correct answer is weekly. The sooner you get your money, the better. If they gave you an option being paid daily, you should say yes to that. Yeah, pay me at the end of every day. Because the sooner you get your money, the more valuable it is. If you ever had a job where you're paid monthly, you'll know exactly what I'm talking about, because that is the worst job to have. Because you're live like a king in the first week of the month and live like a pauper the last week of the month. By the way, if you're retired, a lot of your retirement money comes in on a monthly basis. Social Security or dividends, you get it on a monthly basis. So it's not so far-fetched to live that way. But the concept is the sooner you get the money, the better, because you can reinvest it. So, for example, if you're getting paid in the first of the month versus the end of the month, in the first of the month you have a good stock deal you could purchase, you could take that money, invest in the stocks, and double your money by the end of the month. If by being paid at the end of the month, it's not worth it. And the reason this money deteriorates is inflation. So $15,000 in 1970 could buy a nice house. $15,000 today can't even buy a nice car. And so think about that. In 1970, 40 years ago, we'll say 1974, 40 years ago, you get a house for $15,000. Today, a similar house in a similar neighborhood would cost you $450,000. That's a lot of change in money. Same thing with tuition. In 1974, tuition for the year was less than $500 a year to attend a state school. And now how much is it a year to room and board and attend a state school? $8,000? That's a pretty big change. Wouldn't it be great if it just stayed the same? But the problem is the salaries back then were a lot lower too. Feels like to me when I was in high school, a $20 bill, the purchasing power of a $20 bill when I was in high school is equal to the purchasing power of a $50 bill today. So for example, with a $20 bill, you could easily go to the movies and go out to dinner with two people. Today, you might need a and when I'm saying going out to eat, not like a fancy restaurant, but just like fast food or something like that and going to the movies and getting drinks at the movies. Today, you're going to need $50 to do that. 2 tickets to the movies is going to be like $30 for 2 tickets, depending on, and then $20 for popcorn, right? That's what it costs. Maybe $10 for popcorn, $10 for soda. I don't know. It's a lot of money. And that's the inflation. In some areas of the economy, the price of things grow faster than other areas. For a long time, gasoline had a stable price, and then out of nowhere, it doubled in less than 2 years or 3 years. But for 10 years or 15 years, gasoline didn't change much in price at all. And then within a 3-year scope, it doubled or more. So inflation can be very uneven, yes. Well, the normal person, no. But if you're an economics student, maybe you would also, or a business finance student, you may want to consider the value of the dollar, because if the dollar is going to shrink in value due to the reduction of its usefulness as a world currency, then that might be an issue. And if you get the money today, you could move it into other currencies to protect yourself from any one currency devaluating greatly on the world scale. But again, that's out of scope, a little out of scope for the class. Save it for your economics professor, right? Are you an economics student or AMS student? Yeah, save those questions for those guys, because we're just business students here. We don't think that deep into economics of the world. We're more about making money, you know. So we're not worried about 20 years from now. We want to make our money tomorrow. We want to graduate and get our $50,000 a year job and then start spending that money or investing it to make more money. So any type of investment where the present values equal or exceed the cost of the investment, that's going to be a satisfactory investment. So the reason we look at time value of money is that, just like we said with the lottery, if you're going to get something paid to you over multiple years, you're going to want to have to discount that to make it comparable. So if I did have that lottery problem, $300 million over 20 years or $120 million today, you would have to actually do a time value of money and discount that $300 million to today's value to see is it equal to $120 million. And if it isn't, maybe, you know, if I said $50 million today or $300 million over 20 years, you'd probably take the $300 million over 20 years because that's a bigger value. But if I said $200 million today or $300 million over 20 years, you'd take the $200 million today. So there's time value money has the formulas where you can compare money through time, present time and future time. Okay, so required rate of return or required return is basically you want to cover certain bases. You want to cover the real rate of return. So this is going to be sort of what you're making above inflation and risk. So you have these two elements, inflation and risk. So whatever inflation is, say it's 3%, you want to make sure that if you have this investment for a year, you're going to get that 3% return in your money. So if you put your money in a CD and it makes 3%, you've covered your inflation premium. But there's also a risk premium. So with a CD, there's zero risk premium because you're going to get the money. It's guaranteed. There's really no risk of losing it. So that would be zero. And there's also no real rate of return because if inflation is 3% and your return is 3%, there's no real return because your money went up 3%, but everything else it can buy went up 3%. So you have really made nothing. So in this situation, if it was a certificate deposit for 3% and inflation was 3%, you know, your inflation premium would be 3%, your risk would be zero, and your real rate of return would be zero because you're really not getting anywhere. But at least you're not going backwards. Having your money in, say, a shoebox under your bed, you would actually lose 3% of the purchasing power of that money. Okay. Yes. I couldn't hear you over the air conditioner. Okay, I'm glad you asked that. The risk premium for investment, an example is you buy any type of technology company and you have a risk that that technology will be eclipsed by some other technology and the company will go out of business. So the riskier the company is, the more risk premium you'll need for that investment. So if you put your money in a risky stock, you're expecting, you know, if you have a choice between two stocks, one's not risky and one is risky, and they both have the same return, you're going to put your money in a non-risky stock. But then they said, listen, you're going to actually have 3 times the amount of return if you invest in a risky stock. Then you might think about taking on that risk premium, going into the riskier stock. So if the investment has any type of risk to it, you're going to have to equate that to a premium that you're going to need as compensation. The riskier the stock, the more premium you're going to need. So if you add these 3 elements together, the amount for inflation, the amount for risk, and hopefully an amount above inflation and risk. Because if you're getting compensated for your risk and compensated for inflation, and you're getting even more return, then you might be, then that's called the real rate of return. Any amount of or percentage of return above inflation, above risk. You know, so your required rate of return, you can think of it as the risk-free rate plus the risk premium for investment. So together, the real rate of return plus the inflation premium is going to equal the risk-free rate. So if you just add those together and made a new name, those 2 elements would be risk-free rate. Right. These concepts will mean more in later chapters once we apply them. So the real rate of return, as they explain, is the nominal rate minus the inflation rate, and it sort of measures the additional purchasing power provided by the investment. So it's just a fancy way of saying, you know, what money am I going to get beyond the inflation of this investment? And the expected inflation premium is going to be equal to the rate of inflation is expected for the economy in the future. I always like to think about it as 3% for the U.S. economy. Some years it's less, some years it's more, but it's always been around an average of 3%. So whatever investment I make, so if I make an investment in a bank account that pays a half an interest percentage, I'm really losing 2.5% on that money. So that's why you shouldn't really have your money in a no interest bearing savings or checking account, because your money's going backwards. So you want to, that's why it's critical that you know about investments and know about other vehicles to invest your money in, so you don't lose money to inflation. Okay, so like I was saying before, we have this concept risk-free rate, which is the combination of the real rate of return and the inflation premium. So this is basically saying if there was no risk in the investment, the investment is absolutely non-risky, like a certificate of deposit or a 5-year treasury bill. The two things that you only have to look at your risk-free rate, because there's no risk, so all the return is risk-free, is the rate of return plus your inflation premium. So if you take out the risk of a investment, or you subtract out the risk of the investment, we call that the risk-free rate. And sometimes if we break out the risk-free rate in the equation, we get the real rate of return and expected inflation. But if we add them together, we call it the risk-free rate. Right. So the risk premium that you were asking about before, that's any additional return you're going to need to accept for a risky investment. Say, for example, there was a 6-foot hole in the floor that led to a lava pit. How much would you want in compensation to jump over that? Would you do it for $100? I would. 6 feet is easy to jump over, especially if you get a running start. At high school, I used to be able to jump 16 feet, a long jump. So that, for me, 6 feet's nothing, even at this age. $100? Sure. But what if I made it 10 feet across? Would you do that for $100? I wouldn't. But would you do it for $1 million? And you could do one of those things where you jump and you grab the ledge and then pull yourself up like you see in all the movies. $1 million. Would you do it for $1 billion? Don't raise your hand if you'll do it for $1 billion. Okay, so everybody will do it for $1 billion. Don't raise your hand if you do it for $50. Okay, if you're not raising your hand, that means you're going to jump over this 10-foot lava pit for $50. That would be a bad investment. But the concept is simple. The riskier the endeavor, the more you're going to want to be compensated for doing it. There's a certain point where, there's a certain price where you're like, yeah, I'll do it for, $100 million. If you ask people, some people would be, if they pose the question to you, how much if you let me cut off your toe? And some people would say, I wouldn't accept any money if you cut off my toe. And some people say, I'll take $5,000, so what do I need a toe for? It's just whether you're willing to take on that risk. Okay. Looking at return, you have your holding periods, which is going to be your return over a specific period of time, your realized return, and your paper return. So your paper return just means you haven't sold the asset yet. So if you bought a stock at 60 and went to 90, you still own it, it's a paper return. It's not a real return. A realized return is when you actually sold the investment and got the money, and it's in your account. And there's a big difference because unless it's real, If no sale, it's only real if the sale has taken place. So to calculate this is, fairly simple. The income, any income such as dividends you make during the period plus the capital gains divided by the beginning investment. And the capital gains are going to be whatever you bought it for minus whatever you sold it for. And that could be negative or positive. And just like returns can be negative or positive. So the holding period return is just whatever specific period you want to do it in. A day, a month, 2 years. You just start at the beginning and subtract from the end. And you get that percentage return for that period. So if we looked at, for this particular period, I don't know how long this is, say you had investments in savings accounts, stock, bonds, and real estate. And by doing that same equation of looking at the income versus the purchase and sale price of the investment, you can calculate the return. And here we have 4 different returns. And of course, you can actually calculate the total portfolio return. If you weighted average each of the investments and the percentage return for each investment, you can get a whole, actually, a weighted average return for the portfolio. Okay, so holding period returns are very easy to calculate, easy to understand, and to consider growth income. But a disadvantage is you're not using time value of money. So if you're doing a holding period return on your investment, and you had an investment for 10 years, and over 10 years it returned 10%, you've actually lost money on that investment because of inflation. So because it doesn't calculate or consider time value of money, the rate of return is inaccurate the longer the period is that you're looking at. Photocopier. Okay. An internal rate of return is something you should also have covered in Finance 330, and it's just looking at the compound annual return earned on an investment held longer than a year. So it's a way of saying that I had $1,000 in the beginning, and it's going to be worth $1,400 at the end of the 5-year period. What's my internal rate of return, or how much have I made on an annual basis? And this is something that I'm not going to expect you to calculate this for the test, but it's best done in a spreadsheet because you can't really calculate it by hand too easily. So you either need a financial calculator or a spreadsheet. And when you're in a spreadsheet, you just look up formulas, internal rate of return. Very simple to calculate. And if you were in my 330 class, I did that rather vigorously in the class. All right. So the idea is to get to take an internal rate of return gives you a percentage return, not a dollar amount. So what's good about it is it uses the time value money, and it will incorporate time value money in your actual return. And it allows you to look at different investments, compare different investments to each other easily for the same period of return. The disadvantage is that you usually need you can't really calculate it on a small calculator. You need a financial or a spreadsheet to calculate it. But it gives you a much more accurate, a much more comparable rate to look at returns of different investments over periods of time that are going to incorporate the time value of money inside of it. All right. So if you're going to have a stream of income, you can use an annuity, like an annuity, so you can have a bond or something, or even that lottery winnings paid to you every year for 20 years is a stream of income, sometimes called an annuity. And we could calculate the internal rate of return of this over a certain period of time, and inflation can be looked at as the discount rate. But internal rate of return, we actually want to set the discount rate to 0, or whatever rate that we can make it so that the present value will equal 0. All right. So let's skip through that. I'm going to skip through that a little bit. The one disadvantage, another disadvantage in internal rate of return, it assumes any money that you make on this investment will be reinvested at the same rate of return. And that's not always the case, because sometimes you might make a dividend off an investment and keep it in cash or not reinvest it back into the same investment. So that is another limitation, that it's assuming all the reinvestment amounts of money earned during the life of an investment are going to be reinvested and have the same rate of return, which isn't always the case for a lot of investments. Okay. That's why we also have something called the reinvestment rate, or the rate of return you might get upon reinvestment into that. So if you bought a stock and it went up a great deal the first year, but was slow to grow the next 5 years, your reinvestment rate over the year 4 through 5 is going to be a lot lower percentage return than the initial investment rate on the first year when the stock, say the stock doubles the first year, but then only goes up 10% in the next 4 years. So if you're reinvesting at the slow side of the growth, your reinvestment rate is going to be lower than you might have expected, or lower than the actual return of the whole investment. So it's just something to kind of think about. And, of course, the fully compounded rate of return is going to be earning money on your interest, or on your whatever money the investment generates. So a compounding is earning interest on your interest. And that's what really accelerates the growth of money quickly. So that's why in the stock market, the rate of return generally a lot higher is because the compounding, if you compound the money back into stocks every time you make money with stocks, you keep fully invested. That's why it's so dangerous to pull your money out of the stock market, not be invested, because as little as 5 of the best days of the year can result in 80% of returns for the year. And you're not going to get the full compound rate if you pull your money out, or don't reinvest your money in the product in the same investment over that same period. All right. This is just a graphical view of different rates of return. So if you had a 0 rate of return on a $1,000 investment, you're going to get, have the same amount of money at the end that you did at the beginning, sort of like a bank account. If you have a 5% rate of return, you're going to earn $1,600 of interest in 20 years. And if you have an 8% rate of return, you're going to earn double that, or almost double that, at $4,600 over 20 years. So this is just the basic concept as far as earning interest on the interest. It really is, that is what accelerates your growth the most. So you don't want to make money on a stock and then, say you have the stock, you put in 10,000, and next year you look and it's at 15,000. You say, well, let me sell some shares to get it back to 10,000, and I'll keep that $5,000 I made safe in a bank account. That's what's going to really slow your growth. You want to keep that money invested, so you keep returning at higher growth rates. So the rate of growth, it really depends on, of course, the capital gains, but also the stream of income and how quickly the dividends or the income is growing. And some companies do raise or increase dividends continuously. But it's all sort of like, think of that snowball at the top of the hill that as it's rolling down the hill turns into a huge snow mound. And that's a lot like investment, especially when you save for retirement. It may seem like the first 15 or 20 years of your retirement, your money is actually pretty small. But somewhere magically between the 15th and 20th year, it starts to really gain momentum. Then you're surprised every year at how much it returns. All right. This is if you had a financial calculator, these slides on that. All right. You could also easily do this growth rate in a spreadsheet if you had all the returns. And in this slide, it gives you, if you put in all your dividends for every year for, looks like 10 years, there is a rate formula that you can use to actually return the growth rate over that period of time. So Excel has these built-in functions, and this rate function is one that you could do. And pick put in the information of the number of years and the number of returns, and it can produce an annual growth rate for you a little bit more easily than if you did it by hand. Okay. So let's talk about some of the sources of risk. So there's a relationship between risk and return. When things become less risky, the returns also become smaller. So companies that are very small, if you were to invest in Netflix when it was a very small company, you know, there's a point where I remember Netflix trading under $30, and now it's hundreds of dollars. So as the company's gotten bigger and more established and less risky, you're not going to make that same return today that you would have made if you were the earlier on investment during its, say, its first year after the IPO. Because risk is, you know, the chance that of a return is different than what you expect. So when things become more stable and more predictable, there's actually less risk, you're going to get less return. But anytime there's the risk is that you may not get that return. In very risky companies, more often than not, you don't get the return that you're hoping for. Now let's go back to business risk, which I mentioned earlier. And this would be a business risk would be an example of specific company risk that, you know, maybe you're a fast food chain and you wind up accidentally poisoning a lot of people through salmonella or some poor sanitation or a problem. You know, Taco Bell had a lot of these issues where they had people were getting sick from their food, and then at one point there was a big thing saying that their meat was really bad or the meat was mostly oatmeal, and you know, and temporarily there was a slowdown at Taco Bell, but it didn't affect the parent company much because Taco Bell is a conglomerate with Kentucky Fried Chicken, A&W, Pizza Hut, Long John Silver's. So there are so many, you know, other restaurants and other sources of money for the head company, which is Yum Brands, that, you know, Taco Bell did hurt a little bit, but people forget as they do, and the company recovered. There was a company that didn't recover on Long Island. There's two fast food companies that had a problem on Long Island. One was Jack in the Box, and there was a period where the hamburgers actually killed a few people due to poisoning. And they have disappeared off the island. They still exist on the West Coast, though. They're still around. There's also Roy Rogers. Does anybody know Roy Rogers? Okay, they exist. And if you drive outside of Long Island, especially like, say you're in a Jersey Turnpike, there's plenty of Roy Rogers around. It didn't make it in Long Island. Why is that? The business risk. The food environment is just too tough on Long Island. There's too much competition. Just drive anywhere, and it's just one fast food place, you know, pizza, deli, bagels, fast food, restaurants. It's just Chinese food. It's just a lot of competition. So the business risk is that if your company isn't the strongest, they can be squeezed out of major markets where they can't compete easily. It was very difficult for Krispy Kreme to compete on the island, and they were pushed out as well. They had a number of locations for Krispy Kreme. It still exists, it just wasn't able to compete here on the island. And that's all business risk, bad management decisions. The bad management decisions for Krispy Kreme is that they should know that Long Islanders are coffee freaks, and if you don't have good coffee, we're not going to stop there for your donuts. But if you have crappy donuts like Dunkin' Donuts, but have good coffee, then we'll stop there. Because coffee is what matters, that's what comes first. Everything else is secondary. You know, it's one of the reasons Starbucks does particularly well, because people like their coffee. So for a long time, all their food options were horrible. They've gotten better, but as long as the coffee was good, they could live off of that. You know? Even on campus, I see people who can't afford it are still walking around with $5 cups of Starbucks. Because they have something different to offer. They have a food product that is locally sourced, more natural, more organic, and they have basically something that tastes good and is significantly different than most other food operators that, you know, people go for it. People like it. They just have a winning formula, and that's why they were able to emerge out of Colorado and go national, because they had something special. I can't put my finger on it 100%, but if you've ever been to one, you know that it's a different experience, and the food just tastes really good. It's so good that you have companies, local companies like Carbo Fresh, copying them, the whole format, and they're doing well too. Because their business model is a success. And the proof of it, generally these companies wait a while before they come to Long Island. But if they're strong enough and have a strong momentum, like Chipotle Mexican Grill, they will come here because there is money to be made here. Even Walmart and Kmart were very late to coming to Long Island compared to the rest of the country. But they definitely, companies do want to come here because there's a lot of money in this area. It's one of the richest areas in the whole country. So companies do want to have a representation here. And if you can make it, if you see a brand in Manhattan, a store, a restaurant, or fast food in Manhattan, you know that it's got to be good because the rent there is phenomenally expensive. So they won't last long unless they have a good product. All right. Financial risk is more about managing the money and paying the debts and the financing charges. So you could have, speaking of fast food, you could have a great, Boston Market. Originally it was Boston Chicken, and it was as big of a to-do as the Chipotle Mexican Grill was, where they were opening up thousands and thousands of locations, and people loved it and was mobbed all the time, and it was just a really hot business. However, they borrowed money too aggressively, sort of like if you took your credit cards and charged them all up and then had to pay that off. They borrowed money at high interest rates and pretty aggressively to expand while the demand was there. And they expanded so fast and borrowed so much money at such high rates that eventually that collapsed in on itself and they went bankrupt because of the financial risk. They just weren't able to maintain the money they had borrowed. And then McDonald's bought them and later sold them. But McDonald's bought them. They got the business for free. They bought them basically on their real estate value. Because they had to pay off the debt of that company, which was phenomenal. And that's a financial risk. You may have a company like Boston Market. It's a great company, makes money. People like their locations. They're still open today. But they just financially, the managers didn't know how to financially responsible in the money they borrowed and the amount of interest they had to pay for them for it. Purchasing power risk, as far as a risk, is more closely tied to the changing price levels of inflation or deflation. So if there's going to be inflation at a high percentage, a lot of investments are just not going to make sense. And if you do invest in them, you're going to be getting a negative return. Safe investments like treasury bills and bonds, if you have 3, 4, 5% inflation, now you're not making any return, you're losing money. So this is a risk of investment, is that, and if you take countries like, say, Argentina that have experienced very high levels of inflation, that wipes out majority of your savings and your investments are all negative. It's just, this purchasing power risk, when prices double or triple, can really turn you in from someone who's middle class to a poor class very quickly. And that's one thing, governments really strive to prevent from happening. And that interest rate risk, which is closely tied into the purchasing risk, is that, interest rates will go up and destroy your return. So if the higher the interest rates, as interest rates climb, bonds get devastated. It really destroys bonds, and it also hurts stocks. Because when interest rates rise, the older bonds are less valuable because they pay lower rates. So no one's going to buy a bond that pays a rate that doesn't meet inflation. They want the newer bonds that do meet. So the older bonds generally suffer a great deal. Interest rates generally rise to combat inflation. So if inflation is going to develop, which is what leads to purchasing price risk, if inflation develops, the Federal Reserve, as you know, will raise interest rates, which they said last week they're looking to do next year, to help control or limit inflation. So in a sense, raising the interest rates is a risk for stocks and bonds, but it's a bigger risk if they didn't raise interest rates and control inflation. So it's sort of a disappointment that stocks and bonds and interest rates go up, but it is appreciated that they use it to control inflation, so long term, the stocks and bonds pay off better. As far as liquidity risk, this is looking at how liquid your investment is. If you have money in a savings account in the bank, you can go there at any point during the day and take that money out through an ATM. So it's the most liquid you can get. But if you put all your money into a real estate, buy a house, it's going to take longer to sell that. It's less liquid. So liquidity is a certain risk. So if you get involved in an investment that you can't easily sell the next day, there's some liquidity risk. So if you have a real estate house that you want to sell and the real estate market is dropping and you can't sell the house for a year or two, you may be losing $10,000 every year that you're trying to sell it or more. And that's why people get scared and they cut the price of their house to sell it faster, and that sort of brings the prices of the market, the real estate market, down even quicker. And that's why liquidity, is a big fear, because you want to be able to get out of your investment while the getting out is good. And of course, there's a tax risk, and this is going to be related to the government changing its tax policy. So if you have, investments that are tax-free, certain real estate transactions and municipal bonds have a tax-free status, and the government's going to certainly decide to tax them. That's going to make a negativity, a risk, and devalue your investment if the tax goes up. If the government turns around and changes the capital gains tax laws and makes them more aggressive, that's going to also be a risk to investing in stock. So tax, and this is something you face for not just this country, but if you have investments in other foreign countries, sometimes they may change the way they tax you when you earn income or buy or sell your stocks in those foreign countries as well. There's also event risk. And this is a risk that no one can really predict. It's just sort of an event, a war, an earthquake, a bad storm, an event that wasn't foreseen or predictable. Supervolcano, which I saw a program on the Discovery Channel. Did you see this? The supervolcano under Yosemite National Park, that if it goes off, it destroys the whole country. Looked it up on the internet, supervolcano, Yosemite National Park. Is it something I should worry about? No, because it happens only once every few million years or something like that. But hey, you gotta get people to watch these TV shows, so they have to make it seem like it's a more imminent threat. But that's an example of event risk. There's also market risk, which is just the stock market sometimes has a mind of its own. And you may be in a great company, but if the stock market is going down, you're going to be a victim of that market risk. So the company did nothing wrong. Sales are growing, profits are growing. It's just that people are taking their money out of the stock market. So if the stock market goes into a bear phase and goes down, then all invest sort of like a tide. If you've been in if you've ever had a boat or experience by the shore or ever been in the beach, and so then the water comes up and starts hitting your blanket, when the tide comes in, all stocks sort of have a lift from that. And when the tide goes out in the bear market, all stocks get pulled down somewhat. But you say, but this stock still went up. Yeah, it went up $5, but if it was a bull market, it might have went up $10. So it's going up, but it's still not going up as fast as it could based on this market risk. And then this currency risk, which my friend in the back was talking about earlier. So currency risk is also a risk for investing, as far as if you're investing in foreign stocks, the difference between the dollar and these foreign currencies can strongly affect your returns. You could have investments in other countries where the stock itself may lose 5%, but if the currency went up 20% in the same period, you still made a profit, and vice versa. You could have the stock go up, but the currency go down, and you wind up having a loss even though the stock in the foreign country went up. So currency exchange, if you've ever traveled between countries, you'll know that exchanging your money between currencies is always a losing proposition, because the bank gets in the middle and takes a certain percentage of that. So if you've ever tried to even going somewhere as simple across the border from New York State into Canada, and you want to translate your American dollars to Canadian dollars, which is always lately around parity, the banks take a good percentage of that in between. And if the Canadian dollar weakens while you're there and you convert it back into American dollars, you get even less American dollars on the way back. Other currencies are much more volatile between the dollar and those currencies. So if we want to measure risk as far as a single asset, we could use some statistics to help us measure risk a little bit more easily. And we could use the concept of standard deviation to look at a likelihood of the return of the investment based on statistical data or historical returns. So we could see that some investments may, over a 10-year period, they may return between, say, 3 and 5% every year for the past 10 years. So you know that the standard deviation is going to be rather small because between 3 and 5% with this investment consistently returns. Maybe that's more like a bond. Or you could have a stock where you could have a return any particular year in the past 10 years. The return could be anywhere from -5% to +10%. So there you have a much bigger standard deviation if a lot of the points along that are falling in between that range in those 10 years. So you can have a bigger standard deviation, meaning that the amount of return you get is less predictable. So using standard deviation, you can get sort of an idea of risk. Think of the larger the standard deviation, the more risk of your return, the change of your return. But if you're looking at comparing different assets of different return bases, such as that bond and that stock, you can use a coefficient of variation to help put them into like terms. And this on Wednesday, I'll have you actually do these calculations in the handout so they get a little bit more familiar with it. But whether you're using standard deviation or coefficient of variation, the higher the number, the more riskier. So if you can't compare, if different assets have different returns, you can't use standard deviation to compare the different assets. However, you can use the coefficient of variation to compare those different assets with different return bases. And again, the higher the coefficient of variation, the more risk the asset has. And when we say risk, we're measuring the dispersion of the amount of potential return. All right. There's a chart in the book that looks at the standard deviations for different asset classes through the 1900 2011 that you can check over in the textbook. If we look at sort of a risk, a scale of risk, we would look at the risk-free rate is generally considered to be the same as the U.S. government securities, because U.S. government securities are considered the one investment in this world that are risk-free. It's just considered that. So if you ever want to know what today's current risk-free rate is, you would look at one of the U.S. government securities. I think it's usually tied to the 10-year note. Then after that, deposit accounts and certificates of deposit. These are your money in the bank. Then you would have bonds, preferred stock. Preferred stock is it's a stock that sort of acts like a bond and pays you a guaranteed dividend. Convertible securities, which are bonds that can convert to stock. Then mutual funds, real estate, and I don't have to argue with anybody over real estate anymore. You can see how risky that has become. Common stocks, options, and the futures are the most risky. So this would be sort of the risk-return trade-off as far as your risk versus your return on a scale. Now this is 100% for every investment within these classes, but this is generally a scale you look at from the least risky to the most risky investments. Now, perception in the individual investor's eyes and their association risk is sometimes can be very different. You know, the risk indifferent is sort of the dumb investor that doesn't really expect any additional return for the additional risk that they may take on. Most investors are risk adverse, which means that if there's going to be more risk involved, I'm going to expect more return. If I'm going to invest, so the risk of the investment, and that's the common sense investor. Then you have the risk-seeking investor who accepts a lower return for greater risk. And these are people who are probably involved in penny stocks, who expect, I'll probably lose money, but I like the thrill of these penny stocks. It could be, if you want to think in terms of sports, sometimes some people, the riskier the sport, the more attracted they are to it. So they're not, just satisfied with tennis. They want to do snowboarding on a diamond slope, or skydiving. And they're actually seeking this risk because that's the thrill of, and some investors are investing for thrills, not really for common sense return. And that's who would be the risk seeking. So you want to be the risk adverse, where you're conscious of risk and you want a proper return for any risk that you take on. And you also want to be able to measure risk to understand the risks you are taking on. Because sometimes the investment may be undervalued because the risks are overstated, because people just don't understand the market. If you look here, this is just basically a graphical representation of the risk indifferent, the risk seeking, and the risk adverse. So you want to be that risk adverse. So as risk moves from X1 to X2 increasing, you're going to want to have, you're going to be more adverse to that risk, meaning that you're going to fight it. You want some kind of compensation for it, or you're going to move away from it. So if an investment is not going to likely pay you more return, but suddenly going to get riskier, you're going to want to move out of it and move into something different. Okay. Okay, so some steps in the decision process of this risk and return is you definitely want to incorporate present value methods in looking at your returns, because they're not accurate returns unless they're reflected by the present value. Assess the overall risk of the investment, hopefully using some statistical measures, some standard deviation, coefficient of variation, to get a better idea mathematically, put a number on that risk. And then look at each investment in this, each different investment possibilities you have in this light of this risk scale, and of, so are there alternatives that you can put your money into that will better fit your risk profile? So selecting investments that's going to have, you always want to get the highest amount of return with the lowest amount of risk. And that's what we're all fighting for, and that's why we're all doing this research and analysis and investment, is that we're constantly looking for this. And we may find it in a certain period, it's good for a while, but then that changes and it's not, it becomes, the risk is not being compensated for. All right. So that's chapter 4 in its entirety, as far as the review of rates and return, the role of time value of money, the risk-free rates, calculation of yield, sources of risk, and understanding the risk of a single asset, specifically through statistics. Now, what's important is on Wednesday, I'm going to review and reinforce for the exam on Monday. I'm also going to have some handouts that are going to reinforce specifically the statistical part of this chapter, the standard deviation and coefficient of variation on investments and risk. I'm not going to really go over time value of money because that's something you should have covered, but there is an appendix at the end of chapter 4 that can review it for you if you feel a little weak on that subject. The test isn't really heavy on time value of money, but it's a concept that you should know alongside of risk and return. So make sure, and just for those people in YouTube land, I'm not going to be recording the review of the tests in person in class only. So I'm not going to be wearing this headset on Wednesday, because Wednesday we're going to be doing handouts, talking about the exam, and going over what you should study and what main topics are going to be on the test and things of that nature, and reinforcing some of the stuff we learned in chapters 1 through 4. So I'll see you Wednesday.